It is saying the quick ratio of a company is 0.8:1. It is 0.8. You should mark here 0.8:1. State with reason whether the following transactions will increase, decrease, or not change the quick ratio. Again, we have to decide whether this transaction will increase or decrease, or there will be no change in the quick ratio. Now see the first transaction. It is saying purchase of loose tools rupees 2000. Now first you should try to find out the journal entry for this. So your journal entry will be loose tools account debit to cash account. So loose tools is also a part of current asset and cash is also a part of current asset. But I have to check the effect on quick ratio. So first thing that you should be knowing that loose tools are part of inventory and inventory is not part of quick assets. Loose tools are not part of your liquid assets. So if you are purchasing loose tools, however, your loose tools will be increasing, but your quick assets will not be increasing. I hope this point is clear. Then next point is that you are purchasing loose tools and you will be paying cash. Cash is part of liquid assets. Cash is part of liquid assets. So your liquid assets will be decreasing that way. Your liquid assets will be decreasing. Now what is happening? The formula is liquid assets upon, you should keep the formula in front of you so that you will be able to decide. So if I will keep this formula here, your liquid assets are decreasing. Your liquid assets are decreasing. So that's why your numerator is decreasing, but there is no change in the amount of current liability. So that's why your ratio will decrease. Your liquid ratio will decrease. And what is the reason? Because quick assets are decreasing and no change in current liability. No change in current liability. Now coming to the next. Insurance premium paid in advance, rupees 500. Now you are paying insurance in advance, so it will become prepaid insurance. The entry will be prepaid insurance account debit to cash account. Prepaid insurance account debit to cash account. Again, your prepaid insurance, your asset is increasing, but prepaid insurance is not part of liquid assets. Prepaid insurance is not part of liquid assets. But because you are paying cash, so cash is part of liquid assets, so your liquid assets will again decrease and there will be no change in current liabilities. So your numerator is decreasing, but your denominator is unchanged. So your ratio will again decrease. Again, the reason will be same. Quick assets are decreasing and there is no change in the current liability. Then third is sale of goods on credit, rupees 3000. Now you are selling goods on credit. So journal entry will be debtors account debit to sales account. Debtors account debit to sales account. Now debtors are part of your liquid assets, because from current assets you are deleting only prepaid expenses, inventories, and advance tax. So debtor is also a current asset, and that will remain in the formula of liquid asset also. So that's why your debtors are increasing. That means your numerator is increasing. Your liquid assets are increasing. But again, there is no change in the current liability. So because your numerator is increasing, that's why your ratio will increase. Your ratio will increase. So the reason will be quick assets are increasing and no change in current liability. Now next is honored bills payable rupees 5,000 on maturity. So now you know that what is bills payable, it is your current liability. And when it matured means the due date is there, you have paid that bill. Honored means you have paid that bill. So now what is happening, you will be doing entry bills payable account debit to cash account. Due to that entry, what is happening, your current liability is reducing as well as your liquid assets are also reducing. So because both of them are reducing, now I have to check it. So suppose the amount is given already here 5,000 and the ratio was given 0.8. So I will assume liquid assets as 80,000. 80,000. And because I have paid cash 5,000, so my cash will reduce, my liquid assets will reduce by 5,000. And same is the case here. My current liabilities will be 1 lakh then, and I have paid current liabilities of 5,000. So my current liabilities will also reduce. Now, if I calculate this, it will be 75,000 upon 95,000. So if you will simplify it, it will become 5. You can deduct it from 5. So it will come 15 and it will come 19. It will come 15 upon 19. And if you will divide 15 by 19, then it will be point something. 15 divided by, it is coming 0.78. 0.78. It's slight difference only, not that much, but even then you can see that it is decreasing. Even then you can see that it is decreasing. So that's why you can answer here decrease. And the reason will be both quick assets and current liabilities have decreased by the same amount. Both quick assets and current liabilities are decreasing by same amount. You can also give an example, this sort of calculation that will also verify your answer. You should give that calculation also. The next one is cash received from trade receivables. Now you are receiving cash from your debtors. Suppose trade receivables include 2 items, debtors and bills payable. So your entry can be cash account debit to trade receivables. Trade receivable is a part of your liquid assets. And if you are receiving cash from them, obviously trade receivable will get reduced. Means your liquid asset will get reduced. But at the same time, the same amount will get increased in cash. So there are two components getting affected of liquid assets. Cash is increasing and trade receivable is decreasing by the same amount. So there will be no change in the amount of liquid assets practically. So that's why liquid assets will not change. And because in the journal entry there is no current liability getting affected, that's why current liabilities will also not change. So because numerator and denominator, no number is changing, that's why the ratio will not change. And the reason will be liquid assets, we have no liquid assets and current liabilities are unchanged or remain unchanged you can further explain that cash is increasing and trade receivable is decreasing. Both are the components of liquid assets. Now next point is sale of goods. So sale of goods entry will be cash account debit to sales account. Now when you are doing this entry cash account debit to sales account, your cash is increasing and that means your liquid asset is increasing. But if your goods are going out, means your stock is reducing. Your stock is reducing, but that stock is not part of your liquid assets. So that's why your liquid assets will increase. And due to the factor that only numerator is increasing, no effect is there on current liabilities. That's why this ratio will increase. So here you have sold goods for credit and here you have sold goods for cash. So you can give the same answer. Quick assets are increasing and no change in current liability. So I hope this topic is also clear. That way we have completed the two ratios, current ratio and liquid ratio. Now coming to the next part, we have completed one portion of ratios, that is liquidity ratios. I will show you the bifurcation. This one, liquidity ratios we have completed, current ratio and liquid ratio. Now the next part is solvency ratios. There are four types of solvency ratios. Why we calculate the solvency ratios? For assessing the long-term financial position of the business. So liquidity ratios were calculated for assessing the short-term financial position, and that's why there is a major role of liquid assets, current assets and current liabilities, working capital. But here you will be assessing the long-term financial position of the company or of the business. That's why long-term assets, long-term liabilities like shareholder fund, current, non-current liabilities, these will be having major role in these topics. Now, so first type of ratio is debt equity ratio. And debt equity ratio is having the formula of debt upon equity. So you can easily remember this formula with the help of the name of the ratio only. Debt to equity ratio means debt upon equity. Means we are comparing our debt with our equity. So now how you will be calculating debt? So for debt, you will be finding it in your balance sheet in non-current liabilities. The components of non-current liabilities in the balance sheet is called debt. And from there you have to pick two accounts, long-term borrowings and long-term provisions. So if you will be adding them, you will be getting the amount of debt. Long-term borrowings will be having debentures, bonds, mortgage loan, term loan, These all details you will be finding in their notes to accounts also. And long-term provisions will be having provision for employee benefits, provision for gratuity, provision for warranty. These type of provision you will find in notes to accounts. These all will be added up and you will be finding your amount of debt. Then for equity, take total of shareholder fund in the liability side from the balance sheet. Whatever shareholder fund is there, share capital plus reserves and surplus, that will be termed as shareholder fund. That is equity. So equity means shareholder fund and debt means non-current liabilities. So debt is equal to long-term borrowings plus long-term provisions. Equity is equal to shareholder fund. And shareholder fund means capital plus reserves and surplus. Capital, share capital plus reserves and surplus. So sometimes question will give you information like this also. Now, one more formula you will be using in some of the questions is what is capital employed? See, you have invested in your business, shareholder fund means equity share capital, preference share capital, and the reserves and surplus which you are having. These are also invested in your business, but these are owners funds. As well as you have invested in your business, the amount of long-term borrowings, the amount collected from debentures or bonds or public deposits or whatever, mortgage loan, term loan, these amounts are also invested in your business. So one component is equity and one component is borrowed funds. So both funds will be added to find out the capital employed. So sometimes question will give you capital employed and then you will be able to calculate shareholder fund and debt separately. Again, the ideal ratio is 2:1. Means your debt can be 2 times of your shareholder fund. That is considered as an ideal position. But if you are borrowing more than 2 times, that is considered as quite unsafe. Because then your capital will be very less and your borrowed funds are too much high. In the long run, maybe that you are not able to pay the interest on time or you are not able to redeem the uh, amount of loan on time on the maturity date. Now, why we are calculating debt equity ratio? It is calculated to assess the long-term financial position of the business. It also indicates the extent to which the enterprise depends on external funds. So this ratio will tell you how much we are depending upon the external funds, means borrowed funds for the working of our business. If dependency is too high, that is quite risky. High ratio means enterprise depends more upon the external funds and vice versa. So if low ratio is there, means you are getting then less than 2:1, that means it is quite safe. And if it is more than 2:1, that will be quite unsafe. We will do a simple question like shareholder fund is given. So shareholder fund we can mention here. Shareholder fund is 10 lakh. This balance sheet will help you in solving many questions. Now total debt is given 15 lakh. Total debt you should remember that non-current liabilities plus current liabilities is the amount of total debt. So out of total debt, current liabilities are given 2,50,000. So if I want to calculate non-current liabilities, which I require in this question, I will be calculating total debt minus current liabilities, I will be getting it. So now I will put it in formula form. Non-current liabilities is equal to total debt minus current liabilities. And if I will calculate it, total debt is 15 lakh minus current liabilities 2,50,000. So my non-current liabilities will be 12 lakh 50,000. means my debt will be 12,50,000. Now equity is already given in the question 10 lakh. So I will put here debt 12,50,000 and my equity will be 10 lakh. My equity will be 10 lakh. So if I will divide it, see you can see 4 zeros are common, so I will be able to delete 4 zeros, then it will remain 125 upon 100. The remainder will be, I should always write in the solution the remainder first. It will also help the examiner to check your calculations and it will also simplify your calculation. You will not get confused. So 1.25 ratio 1 will be your answer. So I hope this one is clear. Then you can see this question. Current assets are given 3 lakh, total debts are given 12 lakh, working capital is given 1 lakh, shareholder fund is given 5 lakh. Again, I will take the help of the balance sheet to clear the picture. Current assets are given 1 lakh. Current assets are given 3 lakh. Then total debt is given 12 lakh, so I will be using that same formula. Working capital is given 1 lakh. Now working capital is given and current assets are given, so I can find out current liabilities. And then after finding value of current liabilities, I will deduct this value from the value of total debt. Then I will be able to find non-current liabilities. So now how I will be solving this question. First, I will be writing the formula of working capital. Working capital is equal to current assets minus current liabilities So working capital is given in the question 1 lakh is equal to current assets is also given 3 lakh minus current liabilities So current liabilities will be is equal to 3 lakh minus 1 lakh, it will be 2 lakh. So now I got the current liabilities. Now the next formula is total debt is equal to non-current liability plus current liability So now total debt is given 12 lakh is equal to non-current liability. I have to find out non-current liability minus current liability is given. Now I have carried 2 lakh. So that way my non-current liability will be lakh plus 2 lakh, 14 lakh it will be. Wait. It should be add. I put the wrong symbol. 12 lakh minus 2 lakh, it will be 10 lakh. So now my non-current liability I find out means debt I have calculated, and then shareholder fund is itself given. So now I can put the values. Debt is 10 lakh and equity is given 5 lakh. So my debt equity ratio will be 2:1. My debt equity ratio is 2:1.